For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Now, time for the show. Welcome back to the program. Johnny Dean, your podcast host here, is Managing Your Financial Future, and we are going to do so once again with my longtime podcast companion, Professor Rick Plum, certified financial planner professional, longtime CFP, and relatively short time accredited wealth management advisor. But it's been now, almost a year, 2? What has it been? How long has that been?
A year or so.
Yeah,
I don't
a year or
remember
so.
what I think it was a year ago, a little over a year ago.
Yeah, whatever it was. Anyway, we're happy to have you here because we're going to be talking about a topic today that I think it creates some confusion from people because of the name of it. Now, what I wanted to get into was an important thing, at least it's important now, is blending buckets. That's kind of the topic for today. And when we've asked people in the past about blending buckets, in their minds, it goes to, well, I guess I take a little from bucket 3, a little from bucket 2, and a little from bucket 1.
And now that's the wrong way to think of it.
That's the wrong way to think of it for sure. And but I could see that's the name, blending buckets. It is the way it makes it sound. So I can understand where there's some confusion. I even put it on. I even stuck it in ChatGPT. I said, "Do you know what blending buckets is?" And it came up with that same answer, Professor Plum, which was, "Well, you take some from bucket 3, bucket 2." And I said, "No, not quite. Can you give us, just before we get into the meat of it, can you give us just a quick little explanation as to what we mean when we say blending buckets?" Then we'll get into the meat of the topic.
Well, when we talk about blending buckets, we're actually talking about blending the income sources from bucket number 1. Bucket number 1 is our cash flow source. We're going to take distributions from bucket number 1 over the first 6-7 years. What we're talking about when we talk about blending, we're talking about blending the income sources. The income sources are income from personal assets, income from traditional IRA tax-deferred accounts, and income from Roth IRAs. They have different tax treatments. They have different characteristics. And so by taking money from different taxable sources, we have more control over the actual taxability of our cash flow. If I were to, if I needed, $50,000 a year from my buckets, very, very simply, we might have $350,000 in bucket number 1. And so if we were taking $350,000 out of the IRA, or $150,000 a year out of the IRA, all $50,000 is going to be taxable. If we were taking $50,000 from a Roth IRA, assuming we've had it for at least 5 years and we're 59 and a half, it's all going to be tax-free. If we're drawing down $50,000 of principal from a $350,000 personal account, there may be a slight amount of taxation. Let's say that it's earning 4 or 5%. So you've got some taxable interest being earned each year, a little bit less each year as you draw it down, but nowhere near $50,000 of taxable income, even though I have $50,000 of cash flow. Now, how do we go about using that information to try to make it more efficient for you? Well, if you go online, a lot of what you read is always spend your taxable money first. That's the personal money. That's where it's not in an IRA, not in a Roth IRA. It's just spend your personal money until you turn 73 or ultimately 75, when the required minimum distributions hit, and then spend your tax deferred money and never touch your Roth money and leave that for the kids or down the line. But if you do that, you run the risk of really shooting yourself in the foot, because it doesn't do any kind of tax planning. It doesn't understand that the taxes are lower with the first X amount of dollars than they are with the second set of dollars that come out. And if all you're doing is deferring, you're pushing that IRA to grow bigger and bigger and bigger and bigger, which is not necessarily bad. But if I've got 2 accounts that I want to grow, the IRA or my personal account or my Roth account, maybe I don't want the IRA to continue to grow. I want my personal account to grow. So we have to take a look at where we are with the tax brackets now, where we might be if we're a married couple and then become a single individual because somebody passes away, and also who's going to inherit the money, what's their potential tax bracket going to look like. And that helps us blend the distribution from bucket number one, so that from a personal income tax standpoint, from an income-related monthly adjustment amount tax point, from a long-term capital gains potential tax viewpoint, all of these things come into play in trying to efficiently manage your tax return while still maintaining the cash flow that you're trying to achieve.
So the real play when we talk about blending buckets is the tax situation. It's really a tax management thing. And as you mentioned a moment ago, you've got personal money, which may be taxed at different rates or may not be taxed at all, depending on what it is you have. You've got Roth money, which, if you follow the rules and everything's done properly, is tax-free. And then you've got your qualified, your pre-tax money, your IRA money, which is fully taxable at ordinary income rates. And by blending
distribution.
And by blending those, you can manage your taxes a whole lot better. At least that's the idea behind it. So when we talk about this, Professor, you brought up something before the show when I was mentioning this that makes a lot of sense. And it has to do with what happens with the taxation of Social Security. You know, one of the reasons that you do a lot of this blending, take the IRA and all that stuff, is because potentially your extra income now could push your Social Security and your income relate, your IRMAA, we'll call it, IRMAA. That's the Medicare premium, extra premium, could push that into higher taxation. Now, we're looking at, this is not quite mid-2025, but perhaps we'll have a time where
New tax laws.
Well, we don't know. I mean, if Social Security somehow, if you can avoid Social Security taxation, let's say it went away, and I'm not saying it will, but if it does blending the buckets and this tax management play ease a little bit? Does the need for it ease a little bit?
I don't think the need for it goes away. It makes it much easier to calculate. It makes it much easier to deal with. There's two sides of this. One is, right now, depending upon how much even moderate income households have the issue of the taxability of their Social Security coming into play. And it doesn't just come in all at once. If you go over the threshold by $1, it doesn't automatically, boom, 85% of your Social Security is taxable. It's scaled in based on how high above the threshold you are. And so right now we have to be careful. Even people that are in the 12% current income tax bracket, which is not that draconian, of a bracket, but they really aren't in a 12% bracket. That new income they're showing, even though they're in the supposed marginal 12% bracket, that income is being taxed at 22% because they're paying tax not only on the $1 that they took out of the IRA or that $1 of interest they earned or that new dollar, wherever it came from as a taxable event. They're paying tax on $1.85. They're paying tax on that dollar plus 85 cents of Social Security that wasn't taxable before. So at 12% on $1.85, now it's actually costing me a little over 22 cents per dollar I show coming out. So even marginal, moderate families start off basically once they start showing some income and they start taking their RMDs, start taking distributions, they're in 22% bracket. If they do away with the tax on Social Security, if they reverse the 1983 and the 1993 laws that came into place, if they do away with the tax on Social Security, it'll make tax planning a lot easier because it's more direct. It's more visual. You can actually see what's happening. If I'm in the 12% bracket, I'm in the 12% bracket. There'll still be a need to potentially reduce and manage your taxes over time. It's just going to be at a different level.
Yeah.
On the other side, the higher income, the IRMAA limits, many of the people that are having issues with IRMAA have a reasonable amount of Social Security income.
Can you explain IRMAA? I'm sorry, we said IRMAA and we've said it before, but if you don't mind, just tell people what it is. It's the extra charge for Medicare. Just give us the 15-second answer.
Well, IRMAA is an acronym. It's an income-related monthly adjustment amount, and it pertains to the Medicare Parts B, C, and D premiums that we pay. Typically, a retiree who's on Medicare has Medicare Part B, and that is costing $185 a month of premium. If your income, this came about because of the Affordable Care Act back in the early 2000s, basically. If your income exceeds certain thresholds, then you get the privilege of paying more for that Medicare premium. The reality is the Medicare premium that we pay, Medicare Part B, that $185 that we pay, is only 25% of the real premium. The government pays the other 75%. And so the idea is that if you make more than certain thresholds, you pay more of your premium. It goes from 25 to 35 to 40 to 50, all the way up to 75 or 80%. I can't remember the top number.
It's quite high.
It goes up to $630, $640 a month if your income is high enough. So it is an additional premium on your Medicare, which is kind of like an additional tax. You just you get less of your Social Security. You got to pay it.
It is a tax. I mean, it's a tax, is what it is. And so when you say things like IRMA, what you're talking about is if you're paying into the Medicare system, which we all are, then that's going to be raised. So I wanted to just clear that up. I didn't mean to interrupt you, but when we mention IRMA, I want to make sure people know what we're talking about.
And there's different brackets of IRMA. If your income goes over the first threshold but is under the second threshold, it goes up. Your premium goes up by like $75. If it goes over the second threshold but not the third threshold, it goes up by another $100. And this is per person if you're a married couple filing a joint return. So it can go up fairly quickly and it can add up. And it's just one of those things. It's like, why do I have to pay for this? I don't. And sometimes it's even people of moderate incomes will fall into the trap once in a while because their income will jump in 1 year. Maybe they sell a rental house or they sell a vacation house and they have, $200,000, $300,000 a gain, maybe more. Mm-hmm. And that in normal years, they don't have any, they're not worried about the thresholds, but that year throws them way over the threshold. And so then they're going to pay it, just for 1 year though. It will, because they match up your tax returns from 2 years before. And if you're over the limit, you pay the thing. And then the next year, if you're under the limit, you don't pay it the next year. Well, the extra premium.
Yeah.
So managing your taxes is very important.
Well, I don't want
the idea of not having their Social Security taxable, especially for some of these people that are near, that drops in some cases 80. I mean, it could be as much as $100,000 of adjusted gross income off the scale. And so somebody who is at the IRMA limit that's at currently 212, all of a sudden you drop $80,000 off of that. They're nowhere near IRMA anymore.
Yeah.
Or they're dropping way under it. So it makes planning for these things. And now we have more opportunity to do Roth conversions and other things and make life a lot easier.
Yeah. Now you're saying if for some reason the taxation on Social Security ends.
If they pass the law to repeal the taxability of Social Security benefits when you're receiving them.
Yeah. And again, we can only hope that that happens. But okay. But this does not at all minimize, as you just said, it does not minimize the importance of doing tax management. And you can still do the blending of buckets because this is an important thing. We still do, as of now, have required minimum distributions. I don't think those are really ever going to go away, but that can add to, in fact, it will, in most cases, add to your income, depending on what your tax bracket is. So
if you haven't planned correctly, the RMD becomes an addition, or it becomes the only place you're getting income because you've spent all your personal money before you get to that age. And now you're stuck with this pretty good sized required minimum distribution, which could really affect your taxation. I mean, if you're 66 years old, 67 years old, and you have $1 million IRA, you can take 40, if you were to do the 4% rule, you take $40,000 a year. That may have X of an impact on your overall taxation. But then if you don't touch it for 10 years and it grows at 7, 8, 9, 10% over those 10 years, that $1 million turns into $2 million, $2.5 million. Mm-hmm. Now your required minimum distribution is an 80, or it could be $100,000 of just required minimum distribution. Oh, darn, I got a lot of income. Oh, darn, you may have to pay significantly more taxes. Well, that could be a very big impact on your tax bill.
Yeah, and it can be. On this topic of blending buckets, though, the idea is to decide with your financial advisor whether you want to take a certain amount of Roth, assuming you have that, a certain amount of personal, assuming you have that, and a certain amount of IRA. I mean, generally, somebody who is retired has some of at least one or two of those. And that gives you...
Even if you have 100% traditional IRA tax-deferred accounts, That doesn't mean that you can't, over the next several years, create efficiently, effectively utilizing the tax brackets to your advantage, maybe, and create Roth IRAs. And especially not just for your own life, and maybe if you're married, for the survivor's life. Because as bad as a married filing joint return, tax return can be, the single tax return is worse. You still have the same brackets. You still have the 12, the 22, 24, and so on. But you have about half as much income that you can have in each of those brackets before you jump into the next one.
Yeah, and that takes a lot of people by surprise who lose a spouse, let's say. And I'm going to ask you a couple of these questions that we've gotten from people that I've managed to cobble together, as I've been doing for the last few episodes. And I think this is kind of fun to go back and answer some of these because they are still pertinent. Now, I don't know if you can answer this question succinctly, let's say, because we've done entire episodes on this. But I'm going to ask.
Have I ever been able to answer any questions succinctly?
I'm not going to get into that either because we don't have time. But here's the question. Let's see how you do. Okay, and I understand this is a broad question. It is. I have money in a 401k. I have money in a Roth, and I have money in a savings account. How do I know which one to take income from first in retirement?
It starts with understanding what your taxable income looks like before we take a distribution from any of those. And then do we have room in the current bracket to take more taxable income without jumping brackets? So if I'm not taking Social Security yet, so I'm going to ignore the taxation on Social Security. I may have a pension. And with that money, the pension, I'm in the 12% bracket, and I have $30,000 worth of room left in the 12% bracket. Well, if I've got a sizable IRA, I'm probably going to want to start taking money out of the IRA, at least to that $30,000 limit. And then we have to then look at, okay, what's on top of that? Do I need more than 30,000? And if so, where am I going to get it from? Now, a lot of people don't have as many choices as you would think because they may have $1 million in their IRA and 20,000 in their Roth, 30,000 in their Roth. So it's not, the Roth isn't big enough to really help us very much at this point. But if we were to have, 500,000 in each type of account, 500,000 personal, 500,000 traditional, 500,000 Roth, I would look at, I'm going to take 500,000 or 30,000 a year from my traditional IRA, utilize my tax bracket, and if I need more than that, I'll go to the Roth and start taking it out of the Roth to avoid jumping brackets.
It used to be if you had 500,000 in your Roth, then you did a heck of a lot of conversions. But actually, where we are now, I mean, people could have that as contributions over 27 years of contributions. So
and potential conversions. The people I see that with the most money in Roth IRAs got them from conversions.
Sure. Oh, absolutely. Because there is a limit to how much you can contribute to any IRA, including a Roth.
Or they did it from their 401k Roth, where they can currently put, if you're 50 or older, $31,000 a year. Or these mega funded, which we've done podcasts on, mega funded backdoor Roths, which you can put a significant $50,000, $60,000 into them each year.
Yeah.
And that can grow. That actually, 50 here, 60 there, it's every year starts adding up to real money at some point.
$1 billion here, $1 billion there. Next thing you know, you're talking about real money. That's been around for a while.
Reagan or who is it?
No, gosh, I think that was somebody back in the 50s. I have to look. Somebody listening knows this off the top of their heads, but I'd have to look.
Yeah, $1 billion here, $1 billion there. Pretty soon it adds up to real money.
Yeah, exactly.
Stupid politicians.
Not that they're out of touch. So, all right, well, that's a pretty good answer to that, Professor, because I realize that there are different nuances to that, the answer of that question as to which one you should take first. We have devoted entire episodes to that. So I appreciate that, and I think you've given people a nice overview. Another question we had, which you've already answered, is it better to use my taxable account before touching my IRA? I don't want to, you don't need to answer it again, but if I can summarize that, it was, well, again, you need to know where you are tax-wise. How many years do you have until your required minimum distributions kick in? And if you can at all take money out of that IRA without hurting yourself from a tax standpoint too much, maybe use up a bracket, then it's better to touch the IRA first, keep that balance low if you can, so as to minimize your required minimum distributions later on. I'm not answering these questions for you. I'm just summarizing. Did I do all right?
I'm good.
Yeah, that's all right. Okay.
I would have jumped in otherwise.
I know you would have. But that's a question that you've already answered. We have a couple more, and these are a little bit more involved. Let me see if I can find one here. These are listener questions we've gotten once again over the last 7, 8, 9, 10 years. And these were under the blending buckets question, or at least they had something to do with it. Oh boy. How do you determine the optimal blend of withdrawals to stay within a target tax bracket while also reducing future RMD exposure? You kind of did that again, but do you want to address that?
Together.
Right. Yeah. You did it, and I did it.
If I can optimize my withdrawal to the tax bracket I'm in, I'm going to take it up to the top of the tax bracket by taking more out of the IRA than other sources. If I don't need to spend that much, maybe I'm going to do conversions up to the top of the bracket. But in either case, I'm taking money out of my IRA faster than I would otherwise because I'm using the IRA instead of other types of accounts. And by that definition, it's bringing the value of the IRA down, which reduces the future RMDs. Remember, RMDs are calculated based on the previous year balance. So if I'm 73 this year, my balance at the end of last year is what I'm basing my required minimum distribution. If between 65 and 72, I've been using my IRA, and maybe it hasn't grown anything, but it just stayed at the proverbial $1 million number instead of growing to 2 million. Well, that means my RMDs based on a smaller number than if I had not been taking money out of the IRA over those previous 8 years.
Well, these are good questions, and I hope the answers aren't too involved. I recognize we're throwing around terms like IRMA, RMDs, and all this stuff, and I'm hoping we're not making assumptions that people know everything that we're talking about here. Trying to keep this on a level that's easier to understand without having to specifically concentrate on everything that we're saying here. One other question here. Can blending my buckets help me manage sequence of returns risk, or is that more about... or is that more about the asset allocation within each bucket? Now, well, go ahead and address that because I think they have the idea wrong here.
They do have the idea wrong. Sequence of return risk is an investment decision. It's taking money systematically out of assets that have volatility to them. And because we don't know whether, when you have volatility, we don't know whether it's going to be good volatility or bad volatility in the next couple of years. It's got a little devil on one arm and it's got a volatility pitchfork on it. So it's a matter of that's an investment decision, not a distribution decision. So the idea of when we create buckets, we're creating buckets that are the investment decisions, and we create enough money in bucket number one to avoid sequence of returns. The asset location is the next thing. Once we've figured out the allocation, how much money should we have in bucket number 1, 2, and 3 to avoid reverse dollar cost averaging, to avoid sequence of returns, to avoid the untimely downturn in the market. Now it's a matter of we have money in bucket number 1. Should that money in bucket number 1 be tax deferred money, Roth money, or personal money, or blended with all three?
Oftentimes
the assets. And so, yeah, we still, obviously sequence of returns is a big risk, but it is not satisfied or solved or defended against with blending. That's an asset investment decision. That's the first thing we have to calculate. So when we calculate buckets, we look at how much should we have in bucket number 1. Now, when we do blending of distributions, there may be some minor adjustments as to how much money goes into bucket number 1 based on whether or not we're paying a lot of taxes or a little bit of taxes on that distribution. So obviously, if I need that proverbial $50,000 and it's going to be one, and I need to spend $50,000 and it's coming from a Roth IRA, I don't have to gross it up or have extra money to pay for the taxes. But if it's coming from a traditional IRA, I may have to pay $6,000 in taxes on that. So I may have to take more out of bucket number 1 so that I can have that distribution, $50,000 net after taxes, which means I might have to have more in bucket number 1 to start. So those are some adjustments that you make after you've done the initial bucket calculation. Then you make your finesse the finesse painting, the little the short strokes, just making sure everything is dialed in just right.
Yeah, you do the roller first, and then you do the trim, and you make sure that everything is just right. The basic idea again is to manage your taxes with the blending of the buckets. And one of the most common questions we get is that first one, which was, how do I know which one to take first? It's easy to mess that up, though, Professor. You said, I think earlier in this episode, if you go online, generally when you ask a question like, where do I take my IRA first? Do I take personal? Many pundits are going to tell you that it's better to take let your IRA grow. Never pay taxes before you have to. Now, to be sure, what you're talking about when you talk about taking, spending the bracket, you're already in the 22 or whatever you're in, and you can you're going to be potentially paying more from a dollar amount.
Right. If, in the earlier case, I was talking about the 12 and the 22% bracket. If I can pay it in the 12, I'd rather pay it in the 12 than in the 22. Mm-hmm. And so, or if I can pay it in the 22, I'd rather pay it in the 22 than the 28 or the 35 or the 37. I mean, So it just matters. And it doesn't necessarily have to be done on a long term, because there are times where you may change your distribution blend from one year to the next because of something that happened in your life. Yeah. You sell a property and you've got a big capital gain one year. Maybe that year you don't do large IRA distributions to satisfy your spending need. You use the cash from the sale of the property or something else, but that gives you more room of the capital gain bracket, less of the net investment income tax, the NIIT, less of the 20% if you go that far into the 20% long-term capital gain bracket. So I may be on a path where I'm taking my distribution primarily from my IRA each and every year. So I funded my bucket number one with my IRA, and then I sell this property and I've got a bunch of cash, but also a big capital gain. Well, I don't take any money out of the IRA that year, and so that I don't have to pay the taxes. And I just take my RMD, the smaller RMD, if that's what the case. So we're looking at it long term. We're creating a strategy that's expected to continue for a while, but life happens, and you have to adjust. Tax laws change, life changes. Unfortunately, we go from a joint to a single tax return from time. On some retirees I've seen go the other way. They go from a single tax return to a joint tax return because they get remarried. My grandfather got remarried, a couple times. He survived 2 wives, and each time he got remarried again within a year.
This is the one that lived to be 102 or something, right?
Yeah.
Well, yeah. So it's not when you're talking about tax management, it's an important point that you make, which is that it's not necessarily about tax minimization in the short term, year to year. I mean, it can be, but generally
it's tax minimization over my lifetime.
Yes, it's tax management, and that's exactly right. There are people who say, well, I want to minimize my taxes this year and this year alone. Why would I pay more than I have to? Because what could wind up happening is you're going to pay a lot more down the road. So it helps to have somebody who can look down the road and say, well, here are the potential here's the potential minefield you could be looking at down the road. So we try to manage that as best you can. Professor, is this an easy topic or a difficult topic? I cannot decide because the concept seems easy, but
it's easy to talk about. It may be difficult to hear.
Well,
I was actually speaking with somebody the other day. We talk about this stuff so much in our office with the advisors. We're all talking about this. We have it down pretty well, and we can talk about it, and we can talk about it very quickly, and we're understanding each other because we're all coming from a similar knowledge of the tax code, of what's going on, because we've been doing it for so long. But for somebody who is new to this, to taxes. And, I was talking to somebody the other day, they said, most people cannot answer the question, how much do you actually make?
Oh, yeah. Yeah.
And the question I usually ask people is, how much did you pay in taxes last year? In many cases, I got a refund. I didn't pay any taxes. Well, that just means you withheld more than you actually had to owe. But the idea, and if people actually saw the number that said, this is your total tax, I think it's line 17, I can't remember off the top of my head, they'd be like, I paid what? I was like, most people don't know how much in taxes they pay in a year-to-year thing.
Well, they don't because
hurts to know that number. It stinks. I made the mistake of adding up what I owe in federal, state, FICA, property tax. I looked at the number and said, dang, that's like a third of what I make.
Well, and it's not just federal, it's state in many cases for people.
Well, federal, state, FICA, property tax.
Local,
in the state I live in, we've got a state disability income tax. That's a little over 1% on everything you make. Yeah. So you just keep adding these little numbers in, and it starts, a percent here, percent there, and it starts adding up to real numbers.
real numbers. Well, and again, I think that's one of the reasons for this whole withholding deal. Why do you have to withhold a certain amount? I think it's not because of any revenue. They don't need revenue, the federal government. What they're doing is kind of, you don't notice it. You don't see how much you're actually paying. As you said, how much did you pay in taxes last year? I don't know. I only know the bottom line. But if you actually looked at it, you say, my gosh, look at this. I mean, that's
dang, that's going to leave a mark.
That's a car for me. I could have had that. So anyway, this is an important topic. I hopefully we've explained it well enough where people can visualize what it is we're talking about. I wouldn't bring it up if it weren't important, because the tax part of this the tax part of the strategy is really what makes it or breaks it for you in many cases, because taxes are the biggest drag, other than investor behavior. Taxes are the biggest drag on your performance.
But taxes to the retiree are an expense. Well, same thing to a business, but to the retiree, taxes are an expense. It's an expense we don't necessarily like, and it's an expense that if we can manage and reduce over time our expenses, that means that we can get away with less income or have more income to spend on things that we actually do like.
Like anything but taxes. Anything.
Anything else.
Anything else. I am happy to spend money on just about anything else. If you want to know more about this stuff, or if you'd like somebody to look at your tax management, see how you're doing. Are you paying too much in taxes? More than you have to, potentially. Give the folks at Lucia Capital Group a call, 800-644-1150. 800-644-1150. They'll be happy to talk to you about this. As Rick just said a moment ago, they talk about this stuff constantly. I was in one of the meetings where you were discussing some of this stuff where they talked about the taxes, and I thought, they're talking in shorthand here because they do this so much.
That's why I said it's easy. We talk about it a lot, but it may not be easy to listen to.
Well, I'm hoping it is. And if it's not, well, we'll never do it again. But I just know there's confusion out there about it. But talk to the folks at Lucia Capital Group. They understand it. 800-644-1150. As I said, also go online. LuciaCap.com, LuciaCap.com. You can get all kinds of information on not just blending buckets, but tax management. You can get, we have tax resources there up on the website. And don't forget our guides. Social Security guide. We've got the retirement income guide, estate planning guide, and a few others. Find those in the little search bar up at the top and type that in, and you'll be able to download all that stuff for free. Don't forget to subscribe to this podcast, as I try to remind you every single week. Go to Apple Podcasts or Spotify, as you probably already did, one of those two. Subscribe and tell your friends about it too, because there's a lot of important information about this. And you shouldn't be the only one who's the beneficiary of all this wonderful information. You got friends? Tell them about it. We'd love to have new listeners, because I like to see that little count number go up. It's always fun.
That would be nice.
It would be nice. Professor Plum, thank you again. I really appreciate it, as always.
Welcome.
For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean, managing your financial future. We will, of course, be back next week. Take care. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only.
only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.